It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. One of the things I think I need to bring up, and I've been asked about so often recently, is index products. And many people are reaching out to me, and I appreciate it because there's a lot of concern with the high valuations with the markets, and it's a good diversification strategy to protect your downside. So frankly, to diversify, protect your downside always makes sense, but especially at a time when asset valuations are elevated. So what are index products? Well, first of all, I want you to understand this is the golden era of fixed assets. It's literally the best time in 40 years to establish index products, whether it be index annuities, index universal life, etc. The reason why is due to several factors, which include higher bond yields, a higher interest rate environment, why it is literally the best time since the 1970s to look at index products or fixed assets. Really, I guess, give a little bit of a primer and clarify a lot of misconceptions or misunderstandings about index products, index annuities, index universal life. So I'm going to clarify and use this as a primer. Anyone, if you're interested in this or looked into it even fairly recently, the new products are so much better than even a couple of years ago. You might want to reconsider or pass this on to somebody that might have an interest. So first of all, what do index products do? Well, what they do, first of all, is they allow your money to grow safely without market risk. The principal is guaranteed. So regardless if you have a index annuity or an index universal life, the insurance company guarantees the downside. The principal is guaranteed. That is a powerful, powerful tool. You have unlimited upside in many cases. There are indexes available, which I'll get into in a few minutes, literally allow unlimited upside gains. So much like you have with index products or stocks or various things in the markets, you have the unlimited upside. So you're not giving up the upside. That's one of the big misconceptions that exist about index annuities and index universal life. You're not giving up the upside. What you're giving up is the downside. Again, the principal is guaranteed. Also, to make these products even more powerful, is once gains are locked in, they're guaranteed against future market loss. Now, typically, if you set it up in an annual index strategy, which is the most common, this means that your gains, whatever those may be, are locked in at the end of each year. There are 2- and 5-year index strategies where you can lock in gains after a 2- or 5-year period even. Oftentimes, there's additional bonuses involved or incentives, enhancements to increase your return. That's to offset you having to wait longer. The longer you wait, the bigger the enhancement or incentive. There are indexes, for example, that have upwards of 17% average annual return annually over the past decade. These are actual returns that have occurred. When you talk about waiting for 2 years or even 5, enhancements oftentimes can be 125% or more returns in, say, a 5-year period, which means you more than double your money within a 5-year period with no downside risk. This gets very interesting when you start to look at it and really, truly start to understand how index products work. So again, you have double-digit up annual returns on good market years with no losses on bad market years. And to give you an example, many of the reviews that I've been doing recently, in 2025 year to date, most of them fall within the range of about 16 to 22% annual returns that folks have received this past year. So yes, you can get a strong double-digit return on a good market year, which we have seen in 25, 24, for example, but not participate in the down years. Also, again, once you lock that in, let me use a quick example. Let's say you had $100,000 invested in an index product and it goes up 10%. To make it a simple example. Obviously, you have $110,000 a year later. That locks in. Now, let's say the market corrects the next year, goes the wrong way, or the index goes down. you keep your $110,000. You also have the ability to lock in those gains at any time. There are products that allow you to do what's called manual locks, where if at any given time within that 12-month period, that 1-year period or 2 or 5-year period, if you chose those, if the index ran up and you said, hey, I like that return, you want to lock it in, you could do so. You can do it at any time throughout the year. Also, you can do something called auto lock. Let's assume you're 8 months into a 12-month index strategy, and it's ran up. In 8 months, it's gone at 10%, for example. And you don't want to have to wait the next 4 months because it could return back down, or you're concerned about a correction. You can do an upper and lower band auto lock, they call it, where you can set the rate or set the amount below or above that if it goes higher and hits your upper level, you're locked in. And then if it drops below the lower level you set, you're locked in. Therefore, you've locked in that run up or that gain that you received perhaps in that 8-month period, for example. Again, not only do you have unlimited upside potential gains, when those gains each year or each index period, those gains you receive are locked in and become the new principal, but you also can lock those gains in at any time, either manually or through an auto lock situation, so you can ensure that you capture those gains and they never go down from there. Again, once the gains are locked in, that becomes your new principal, can never go down again. I call it a stair-step approach to investing. Literally every year, I love sharing this with my clients, every year we can guarantee that your account value will be the same or higher each and every year going forward. You never have to go backwards. This is extremely powerful when you consider the fact that if you remove the down years, you take any 10-year period, for example, a decade period, typically you're going to have 2 to 4 down years within that period. Go back through history and you'll see that as being true. If you remove those down years and you do not participate in those, overall, oftentimes you can have more money or more gains overall over that decade period. Let me illustrate a simple example. Let's assume you had $100,000 to use a nice round number. By the way, you can do more, you can do less, okay? But let's use that as an example. Your index goes up 10%. A year later, you have $110,000. That locks in. The following year, let's assume the market or the index, whatever, corrected 20%. It dropped 20%. Well, most people, their account value would be about $88,000. If your account is at $110,000 and it drops 20%, 20% of 110 is $22,000, or your account value would be $88,000. So you went from 100 to 110, you drop to 88. Now, in most situations, most investing strategies, the market then corrects. You have to recover from the 88,000 to get back up to the 110,000. How long does that take? Hard to say. It could be a year, 2, 3 even, before your 100 went to 110, down to 88, gets back up to 110. You follow me? So if let's say it took a couple of years to get back to 110, well, the reality is, when it went from 110 down to 88 back to 110, did you really make any money that time frame? The answer is no. And on a typical market correction, how long does it take for the market to correct? Well, the range, the shortest is about 18 months, and the longest is 25 years. The 18 months was the 2020 COVID shutdown, and the 25 years was the Great Depression. The average, if you look out through all the different market corrections we've seen over, say, the last century or so, the average is somewhere between 5 to 15 years. For example, if you were in the NASDAQ in 2000, that was the dot-com run-up and then bust, it was 15 years before you got back to even. Therefore, you made no money for the 15 years if you were invested in 2000. In 2008, if you were in the S&P 500, top to bottom, was a 55% drop, and it took 5.5 years for that to recover. So for 5.5 years, you made no money. Do you have the time to wait 5 to 15 years for it to recover to get back to where you were? If the answer is yes, okay, fine, you can stay with it. If not, you may want to reconsider. That's called risk tolerance. Well, if you do not participate in the downside, like an index product allows you to do, you don't have to recover. So going back to my example, you have 100,000, goes up to 110. The indexes then go down. If you're in an index product, you still got 110. and then say the following year recovers, you go up from the 110 mark, not from the lower number that you would have gone to. Therefore, you have more money, don't you? That is the power of the index product. And this is why I say to people all the time, you really, when you have an index product, you want one of two things to happen. You either want the index to go up, obviously, because you're going to make money. We all understand that. Or you want it to go down, because granted that year it goes down, you don't make any money, but you also don't lose. And then you get to reset at whatever the index is, S&P 500, NASDAQ, or any other indexes for that matter. You get to reset at the lower number, the lower index number, and you get to capture that recovery with a greater amount of money. You give me any decade period of time, typically a good index product will outperform most ETFs, mutual funds, and various things. I've seen it firsthand. I know people don't like to hear that. 26 years of experience that I have seen firsthand. Now, the other last key aspect about this is you can have a great company, you can even have a great product, but be in the wrong indexes. Now, I've shared this before, but this is a game changer. There are over 600 indexes available with over 50 different companies on these index products. How is someone, an advisor, an agent, supposed to pick? We can make some educated guesses, but unless you actually know the results and how these different indexes have performed, you're really flying in the dark. Less than 1% of agents and advisors have access to this proprietary software that provides the 1, 5, and 10-year historical returns of all of these index options. Folks, this is truly a game changer. There are indexes, as I've shared, who have had 10-year results of 17% plus, average annual return. Without this info, again, you're flying blind. And I've shared this as an example I had with a client a couple of weeks ago. Literally, the wife set up an index annuity. We did her annual review a couple of months ago. Her return was 18.5%. She got married fairly recently. Prior to her getting married, her husband had set up an annuity himself with someone else, roughly the same time. His annual return was 1.11%. Obviously, he was not happy with that. And then when I showed him the index performance report showing the indexes he was invested in, none of them had ever returned more than 5% ever in the past 20 years, average annual returns. Now, if they have never performed more than 5% return over the past 20 years, what's the likelihood of them doing it in the future? Pretty darn low. So we adjusted his policy so that to better index options to where his upside potential literally will be double or triple of what it was in the past, the maximum it would have been in the past. This is the difference that I can make for folks in index products where you can take advantage of the best indexes with the highest potential upside gains in the best time we've seen in over 40 years, the golden era of fixed assets, literally. If you're interested in more information on this, contact me at yourpersonalbank.com. Stay tuned in the next segment. I have a little bit more on the index products I want to share, and then there's a whole lot of stuff going on with mortgages and housing and government proposals, or that you need to be aware of.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. If you missed the last segment, I discussed index products, how they really work. I dispelled some common myths, very common myths about them, And if you are interested in these, you have not looked into it, or maybe you did recently even, this is the golden era of fixed assets. It is the best time to look at these products in literally over 40 years, since the 1970s. I have access to index performance reports that can show you the best indexes that have the best upside potential. We have some that have literally averaged over 17% annually over the past decade. I can show you the good indexes, the bad ones. There's over 600 of them available, by the way, folks. I have access to all of them, over 50 companies. If you happen to have an index product, whether it be an index annuity or an index universal life product, and it's over a couple years old, you probably should take a look. Get a second opinion. Let me show you how you can get a much, much stronger return. Oftentimes, in most cases I deal with, folks are looking at 2, 3, and even 4-fold more returns. Even if they have a penalty to get out of the old one, we have products that will pay the bonus. I've got products that will pay up to 21% bonus, folks. And oftentimes, the minimum guarantee on the new product will pay more than what they've been receiving in the old product. So again, if you missed it, go to yourpersonalbank.com. You can go to my website or the app, the Your Personal Bank app. You can listen to any of the previously recorded shows, including this one. Each has its own title. Anything that interests you, I highly recommend going to that. And if you want more information on how, and if you're interested in more information, obviously contact me at yourpersonalbank.com. I just came across a Morningstar article that I found extremely interesting. It turns out Morningstar's Director of Retirement, Christine Benz, says the 4% withdrawal rule is no longer a reliable baseline for Americans in 2025. As she points out, for decades, the 4% withdrawal rule has served as a simple benchmark for retirees. Withdraw 4% of your portfolio in year one, adjust for inflation each year after, and your savings should last about 30 years. But as she points out, new research suggests that today's market conditions call for a little bit more caution. Morningstar's 2024 analysis, based on expected stock returns, bond yields, and inflation, found that a 3.7% starting withdrawal rate offers a safer baseline for retirees at this time. It even goes on and states retirees and might need to plan for 40 years of income because they either are retiring younger or live longer or both, or may need to stay near the 3.1% withdrawal rate. And someone who's looking at a 20-year horizon could safely withdraw about 5%. So based on the time frame, this is the point they're making in the article, which is very valid. Depending on your time frame of how long you likely are going to live, obviously people are living longer. Whether it's 20, 30, or 40 years you're planning for in retirement, your safe retirement rate from a typical portfolio and have a high degree of likelihood of success that you're not going to run out of money in retirement can vary between 3 to 5%. According to Morningstar, the time frame of how long you're going to live plays a bigger factor than probably anything else in terms of what percentage of your assets you can safely access each year and ensure there's a high degree of success in not running out of money in retirement. If your time horizon for retirement is 20 years, Morningstar states you can withdraw safely about 5%. If it's 30 years, that should drop to about 3.7%. And if you're an early retiree or have a longer lifespan or life expectancy, you may need to stay near the 3% withdrawal rate to safely ensure that you won't run out of money in retirement, or at least have a high degree of success that you won't run out of money in retirement. Now, the problem with that is it's almost impossible to predict how long you're going to live. So most people, if they have the funds available for retirement, tend to fudge to the lower side because, well, they just might live 5 or 10 years longer than they were expecting. And that is very reasonable. The problem, though, that comes about with this is, let's assume for a minute you had $1 million invested in a typical portfolio, and you retire, and you're planning on 30 years of income. You're planning for that money to last for about 30 years. Morningstar is recommending that safe level of withdrawal would start at $37,000 a year. Now, that may or may not be enough to supplement your income for retirement. A lot of other factors come into play, Social Security, pension, etc. But the lower the number, the lower the percentage, the less money you have available to live for retirement. If you're looking to ensure that you're not going to run out of money in retirement and you need income, why not consider guaranteed lifetime income riders? As I stated in the first segment, this is the golden era of fixed assets. We're seeing the best returns, the highest returns on index products we've seen in 40 plus years. We have indexes that literally are averaging upwards of 17% average annual return over a decade. I've got access, as I stated earlier, to over 600 indexes and the performance reports to show you which ones have performed well and those that have not. We can choose which ones are more likely to perform better than others. Without that, we're flying blind. But if you're looking for income to supplement retirement, instead of restricting yourself to 3, 4, maybe 5%, like Morningstar's projecting, there's guaranteed income riders for somebody who's retirement age that will guarantee 7 or 8% even income guaranteed for life. In most cases, you can nearly or even double the amount of income you can receive. That's powerful. But secondly, a guaranteed income rider guarantees the money will not run out. You cannot outlive the money. With a typical portfolio withdrawal, if you withdraw 3% or 4% or 5%, as Morningstar is recommending, they're stating that it's a safe withdrawal rate with a high likelihood of success that you won't run out of money. But it's not guaranteed, is it? Things could go wrong. We could have market corrections. Various things could happen, and there is a degree of failure that can occur. There's a certain percentage that are not going to succeed. Well, if you can increase your income by nearly double, and you can ensure it will never run out, you cannot outlive it. In other words, even if the account value goes to zero, the insurance company continues to pay you the income, regardless of how long you live. That's called longevity insurance, folks. You've just eliminated that risk of failure. You've eliminated that risk of running out of money in retirement. For as long as I can remember, every survey I've ever read has shared the same result. When retirees are asked what is their biggest fear when it comes to financial matters, it is the fear of running out of money, the fear of outliving your money, living longer than you. A guaranteed lifetime income rider eliminates that. And because the golden era of fixed assets, we're seeing the best numbers we've ever seen since the 1970s. Literally, you can increase your income immediately to a much higher level than Morningstar, for example, recommends, and guarantee it doesn't run out. So if that's something that interests you, or you have concerns about running out of money in retirement, and you want to eliminate that as a concern, contact me at yourpersonalbank.com. I'll share with you what a guaranteed lifetime income rider can do for you. They are truly powerful. I really didn't mean to get into so much product stuff, but I've been getting asked so many of these questions recently by folks reaching out to me. I really, truly appreciate it. If you happen to just catching the show now and you missed any of the information about index products, how they really work, how it's literally the best time in over 40 years, we have products that are giving strong double-digit average annual returns. I can show you the best indexes with no downside risk or a guaranteed lifetime income rider. Go to my yourpersonalbank.com or the Your Personal Bank app. You can contact me. I'm happy to share with you more information. You can also listen to any of the previously recorded shows. Each has its own topic, and you can listen to any of them that might interest you. Now, I want to switch gears a little bit to something that has come up recently in terms of proposed government policy, and it's this. The issue that I want to bring up is this recent proposal of providing 50-year mortgages. And look, I supported Trump in the last 3 elections, not so much that I liked him as a person personally, but I liked his policies. But I've got to admit, this proposal of this 50-year loan for mortgages, I believe is one of the worst policy ideas I have ever heard Trump propose. And I don't know who he's listening to, but it seems to me like he's listening to a lot of the wrong people lately, and this is an idea that should be thrown into the garbage heap of history. And there's a lot of reasons behind it. First of all, If someone gets a 50-year loan on a $400,000 house, which is about the average home in America today, and if you manage to get a 5% interest rate, which you can't right now, at the end of 10 years, that person will have spent $217,000 in mortgage payments, but only have paid down $23,000 in principal. In other words, that individual, after 10 years, would only own less than 6% of the value of the home. Now, depending on a real estate cycle, let's say that person had lived in that home for a decade, had been making their payments on this 50-year mortgage, and then they're in a situation where they have to sell the property. And if the value of the property dropped more than 6%, do you realize they would be underwater? So that $200,000 of mortgage payments would have just been thrown away. What that means is, who benefits from that? The homeowner or the lenders? It's the lenders that would benefit. I was chairman of the board of a bank in formation for a couple of years. I understand banking and lending, and there's a time and a place for it, but this is not one of those. Now, I'm coming up on a hard break, so I'm going to encourage you to stay tuned in the next segment because I want to share some more things and some more reasons why this 50-year mortgage idea is one of the biggest dogs I've ever seen economically. So stay tuned.
This is Ference, host of Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. If you missed the first couple of segments of this show, I'm going to really encourage you to go to the yourpersonalbank.com or the Your Personal Bank app and listen to the first part of this about the index products, the information I shared. I cleared up a lot of common misconceptions. I also shared that this is the best time in over 40 years, literally since the 1970s, to look at index products. We got indexes that have averaged over 17% annually over the last decade and have no downside risk. You could also grow your money insured with guarantees, tax favored or even tax free, highly liquid in some cases, depending on what your needs are. These are powerful products to maximize your upside gains without any downside risk. And with elevated asset prices, there's never been a better time to look at these products. It's always a good time to diversify and mitigate some downside risk, but especially when you have elevated asset prices. So again, if you missed it, go to yourpersonalbank.com or the Your Personal Bank app or contact me and I'll be happy to share with you more information. At the end of the last segment, I started discussing one of the worst policy ideas I think I've ever heard from the Trump administration. Now, in general, I've been in favor of many of the policies that they have put forth. There's no question that probably one of the greatest accomplishments of Trump 2 has been shutting down the border from illegal immigration. Also, Trump has been very successful in mitigating or eliminating a lot of wars or potential wars around the world. These are good things. He's done some good stuff in terms of energy, helping energy prices go down. He's attracted a ton of investment into the U.S., which in the long run will almost certainly benefit the U.S. economy. So there's a lot of things to like. When I heard the Trump administration put out this idea of helping housing affordability by offering 50-year mortgages, I immediately understood this is one of the worst ideas ever from this administration. There's been some bad ideas from government. This is right up there with some of them. And whoever came up with this idea, whoever advised this, either is a complete economic idiot or they're going to benefit from this. And here's what I mean by it. If a person takes on a 50-year mortgage, do you realize you will not begin paying more in principal than interest until about the 39th year? Most home buyers will never have enough equity in their home and will remain upside down, making them unable to sell. It's kind of the same as a car buyer with an 84-month loan. In most cases, it makes no sense and it's insane. To put things in perspective, to kind of compare, if you took an example of a $600,000 loan, and let's assume a 6.25% mortgage rate, and that's about the best you can get currently. If you take a 15-year mortgage, your monthly payment's a little over $5,000, and you would pay a total interest of about $300,000, or a total of about $900,000 in total payments for the $600,000 loan. You can find this information on any closing documents on a mortgage. Most people gloss over it, but you sign this whenever you sign for a mortgage. And one of the mistakes most people make when it comes to borrowing money is they focus strictly on the monthly payment. That is truly a lack of financial literacy. It's shocking how few people look at what the total interest is on any loan, particularly on mortgages, because they're amortized, which means you pay mostly interest in the early years and not in the later years. On a typical 30-year mortgage, you're paying more in interest than principal, at least the first half of the loan. And I understand when people make extra payments on loans, on mortgages in particular, because they want to reduce the interest. I understand the sentiment behind it. But the reality is if you pay extra in the early years, you're far, far greater ahead than you are in the later years. And the typical person refinances about every 5 years. Now, some of that is being skewed recently because of a lot of people locking into the low interest rates and not wanting to refinance to a higher interest rate, or not wanting to sell and then having to take on a higher interest rate, that is. And that's understandable. But my point is, on the typical 30-year fixed mortgage, the first 7 years is mostly interest. And if you refinance every 5 to 7 years, you're really not gaining much. You're just paying mostly interest. So refinancing a mortgage repeatedly, really, you're just making payments. You're kind of leasing, folks. You're not really buying. And for somebody to refinance on a 30-year fixed mortgage and the second half of it makes almost no sense, unless it's just a financial situation where you have to reduce the payments and you have no other choice, because now you're actually finally starting to knock down the payment. But if you're going to knock down the payment, you want to do it in the early years, not in the latter years, because you're going to knock down a heck of a lot more interest, okay? But back to the loan comparisons, the length of the loan also has a huge difference. As I started to state earlier, use an example of a $600,000 loan and a 6.25% mortgage rate, which is pretty typical right now. If you take a 15-year mortgage, your payment's going to be about $5,000 a month. You're going to pay about $300,000 in interest on about $900,000 total on that $600,000 loan. If you extend that loan to 20 years, your payment's about $4,000 a month. You're going to pay about $450,000 in interest and a little over $1 million in total payments on that $600,000 loan. So not a ton of difference between the 15 and 20-year loans, but there is almost $1,000 difference in payment, so that could be significant. When you extend it to a 30-year mortgage, a $600,000 loan is now going to be $3,600 a month. You're going to pay over $700,000 of interest, or over $1.3 million total. So you're actually on a 30-year mortgage at 6.25% interest. You're going to pay more than double the purchase price. You're going to pay the $600,000 in principal and more than that in interest, so $1.3 million. So your true purchase price of that property isn't $600K. It's actually $1.3 million. And folks, that's real money, because that's money you actually have to pay to a lender. You have to go to work or invest. You have to make that money to pay it. This is the thing you always need to keep in mind. Now, if you extend that out to the 50-year mortgage, this is why I'm so negative to this, and there's some other reasons why. I'll talk about the positives. There is one, but there's a whole lot of negatives. A $600,000 loan 6.25% interest for 50 years, it only drops your payment from a 30-year mortgage by $400. It's $3,200 a month. So you're saving $400 a month, but you're going to pay over $1.3 million in interest, or almost $2 million total on a $600,000 loan. The amount of interest that you pay is more than twice the original purchase price. Who wins in that scenario? The buyer or the lender? Clearly, it's the lender. Only somebody who is in the business of selling properties or building them, or as a lender, would recommend a 50-year mortgage. It makes no financial logical sense. Here's where it even makes less sense. Lenders typically charge a higher interest rate on a 30-year mortgage than a 15-year because there's a little bit more risk for the lender because it's a longer time frame. Well, if we go to 50-year mortgages, guess what's going to happen? The lenders are going to charge a higher interest rate than a 30-year, just like they charge a higher interest than a 15. So the savings that I just shared previously on the same mortgage amount, saving, on a $600,000 loan, that's a sizable, higher than average loan. The savings is only $400 a month. But that's assuming the same interest rate. Guess what? Lenders are probably going to bump it a half a point or so. And so the savings that would have occurred, the monthly payment, is largely going to disappear because of the higher interest rate that lenders are going to charge. So the amount you're going to pay per month will be almost the same on a 30-year versus a 50-year. It makes no financial sense. The only thing that's going to happen, likely, is people that lack financial literacy, which unfortunately is the vast majority of Americans, when looking at a situation where they might save $100, maybe $200 a month in monthly payments, might go for that 50-year mortgage versus a 30, which means it's going to drive the housing prices up and the interest rates up. The lenders are going to benefit, and the buyers are going to get hurt. The homeowners are going to get hurt. Now, the one positive argument is maybe you save $100 or $200 a month on that 50-year mortgage versus the 30. And if maybe your income isn't as good and you're younger, maybe you do the 50 years so you can get in, so you can qualify and get into a home. And then maybe after you make a little bit more money, you can refinance to a shorter term mortgage. Now, that makes some logical sense, but I think overall the negatives far outweigh the positive. It's going to push the price of housing up, which means the people that couldn't afford to get in won't be able to anyway. It's only going to maximize the amount of interest to the lenders. The lenders will benefit tremendously. The homeowners, the home buyers will not. I hope there's been a huge pushback. And if you're listening to this, maybe it's already been denied. I hope that the Trump administration reconsiders this whole idea. One thing Trump overall has been good at is they'll float ideas out there. I get that, to see what the reaction is. And generally speaking, has been pretty good about listening to the American people. I certainly hope that is the case here. And this 50-year mortgage thing dies on the vine, because it's bad all around. Economically, it's not good for homeowners or home buyers. It's only good for the lending industry. If you really want to solve the housing problem, housing affordability, it's really not that complicated. There's a few key things that could be done to fix it. I mean, the real cause of our housing crisis or housing for affordability is that since about 1995, the United States has imported over 100 million people, and that's both legal and illegal, while only building about 30 million houses over that same time frame. It's basic supply and demand, folks. It's not that difficult, okay? So we don't need a 50-year mortgage. It's really a lease, which will probably drive up housing costs more, and it's a terrible idea. This is directly from the Federal Reserve. Housing supply, there was a peak at about 1995, and all housing supply has done since then is pretty much go down. Now, it bottomed out in about 2011 after the Great Recession, and it's slowly been increasing since. So it's been going on the right track. But folks, you need to understand the housing supply numbers today are only at about the same rate that they were in 1990. And our population is far, far greater, especially when you consider the number of legal and illegal immigration that we have seen in the last few decades. And that's why I really believe the 50-year mortgage, not only a bad idea, it's an insult. It's insulting to Americans. We don't want to be debt slaves. We don't want to be slaves to Wall Street. And the 50-year mortgage, it really is, it's like spitting in your face. It's an insult. We didn't vote for this. We didn't ask for this. We don't want to become debt slaves to private equity firms or the big banks or Wall Street. That's probably where this idea came from, frankly. The median home in America costs over $400,000. Mortgage rates are above 6%. Even Fannie Mae came out recently with a study showing if you want to make housing affordable, one of three things need to happen, or a combination of these. Housing prices need to drop 30%, or mortgage rates need to drop below 4%, or average income needs to increase 60%. Of these three things, what do you believe is the most likely to occur? I don't see incomes increasing 60% in the near future. I see some increase because of the amount of government debt and the bond market, the bond yields that are being paid. It's unlikely that we're going to see lower interest rates anytime in the near future. Maybe slightly lower, but not significantly lower, particularly with mortgages. Even if the Federal Reserve, this is a very common misunderstanding, but even if the Federal Reserve drops interest rates, 30-year mortgages are based on the 10-year bond yield, not the Federal Reserve interest rates. And the bond yields are far more affected by the government debt, the massive debt that's being sold. It's the debt that's causing the bond yield problem, which affects mortgages. So our government spending is causing the problem. I don't see that changing anytime soon either. So what's the third and most likely scenario? House pricing needs to come down. And if more houses were built, that would help contribute to that. Now, I'm going to encourage you to stay tuned in the next segment because there's some people that wouldn't be happy about it. So there's a push and pull about this. But I think it's super important for you to understand. So stay tuned.
This is Ferentz, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferentz Toth. Want more information? Contact Ferentz at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferentz Toth.
Welcome back to the Your Personal Bank Show. This is Ferentz. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. In the past segment, I've been discussing a lot about housing, mortgages, the proposed 50-year mortgage, how I think it's an incredibly bad idea for home buyers, frankly, only benefit lenders, in my opinion. If you miss this, go to yourpersonalbank.com or the Your Personal Bank app. You can listen to this or any of the previously recorded shows. I think you'll find it very, very enlightening. Now, some of the solutions to housing affordability are frankly ridiculously simple. One of them is starting to happen, which I'm thankful for, is FHA loan locks to immigrants without permanent residency, which include HB1 visa holders, has now been drastically reduced starting June of 2025. FHA loan locks had been on the rise from the end of 2020 all the way up to May of 2025, and then now have dropped dramatically. Now, frankly, in my opinion, why FHA would be locking loans for anyone without permanent residency is beyond me. In my opinion, it shouldn't even be legal, but I'm thankful to the fact that they are dramatically reducing this. Another challenge with housing affordability is private equity firms and real estate investors bought 1/3 of all single-family residential properties sold in the second quarter of 2025. This is an increase of 27% from the first quarter and is the highest percentage in the past 5 years, and this is according to CNBC. Look, individual home buyers for single-family residences should not have to be competing with private equity firms and real estate investors. There needs to be a more fair playing field. Now, there's a lot of suggestions out there, again, that would solve the problem, in many cases, literally overnight. Interestingly, one of them, and although I'm never a fan of taxes, this is a situation that would actually resolve it, and it's just called the Singapore model. Do you realize that in Singapore, if you're a citizen, your first residential property, there's something called a stamp duty tax. It's a tax that's added to the purchase price of a property. First-time home buyers, that happens to be 0. I'm in favor of that. The second residential property it has an extra tax of 20%, and third and on is 30%. This is for citizens. Permanent residents, first residential, they have a 5%, and then second it's 30, and then 35, increasing scale. So it discourages people from buying two or more homes. If they do, they just have to pay a higher tax. But interestingly, if you're a foreigner, an entity, or a housing developer, your additional what's called buyer's stamp duty tax is 60% or 65%. Non-citizens, foreigners, entities, trustees, and housing developers have to pay a far, far greater tax than citizens. Well, that would level out the playing field. But there's even some other options that are even simpler. Since 1995, our country has built about 30 million new homes. We've brought in over 100 million people, both legal and illegally. Well, it's a simple supply and demand issue, isn't it? How about mass deportations? Freezing immigration? We could ban foreign buyers or tax them more, like Singapore does. How about seizing foreign-owned property? We could put restrictions on institutional buyers or even on second and third homes. There could be a vacancy tax, so if a home is empty, it gets taxed. Airbnbs could be taxed as hotels. You could ban short-term rentals in residential zone areas. And you could tax speculative ownership. Now, look, there's a lot of people who own real estate or investors. I understand this. They wouldn't be unhappy with many of these solutions. But we have to look at the bigger picture here societally. Do we want it to be a situation where the average home buyer, 59, 20 years ago, that average home buyer was 39? Do we want to be in a society where much of the younger population cannot literally afford to buy a house because incomes have not kept pace with the value of properties, not even anywhere close? Look, I'm as capitalist as they come. I'm an entrepreneur. I've owned multiple businesses. I've been an entrepreneur for 30 plus years. But there are things that are basic necessities like food, clothing, housing. Housing should be something where it shouldn't be a nearly unattainable option for younger people to get started. I have 2 young daughters who are in the late teens, early 20s. And I think back to when I was that age, when I was in the Army. And based on the income that I received at that time, which wasn't a lot, you don't make a lot of money when you're in the military, but I could afford a home. But if either of my daughters today earned anywhere near what I was earning as a sergeant in the Army, adjusting for inflation, there's no way possible that they could purchase a home today. And one of the basics of the American dream is to own your own home. And when you lock out a large percentage of a generation of young people where home ownership is essentially unattainable, that will create much, much larger societal issues and problems. One of the key reasons why, if you've seen recent polling with the Gen Z young men, when Trump was elected, was about 60%. It's now down to about 35%. Why did so many of these young men support Trump? They felt like Trump was a change agent and he was going to do something to help them. And he may still do so. But so far, it hasn't happened. They just want to have an opportunity. This is supposed to be the land of opportunity. But when basic necessities like housing become unattainable, it gets frustrating and depressing, and people start becoming more radical. The other direction, and you saw this with the election of Mamdani as mayor of New York. Many young people voted for him because of free stuff. So you're either going to have a lot of these people who are increasingly young people disillusioned because they're not able to buy a home, start a family, live the American dream. You're going to see increased radicalization, more volatility politically. The problem we have is simple. It's a supply problem. We have to fix the supply. The demand's there. You got to fix the supply. And one other factor, if you put it out, do you realize the number of foreign-born people in the United States now are higher than at any point in the history of the United States? And it turns out almost 16% of people in the United States were foreign-born. It's 53 million people, folks. And many of them are not citizens. Many of those even are not legal. Many of them are on work visas or student visas. Examples like HB1 visas, which is supposed to be for the super geniuses to bring in the best of the best. It has been abused by companies in the United States for decades. It's basically been a source of cheap labor for our corporations. And that's why it continues, because the lobbyists influence our politicians. With the amount of illegal immigration we've seen in the last couple of decades, particularly in the last 4 years, to continue to bring 1.2 million legal immigrants in annually is beyond the pale. It's time for a pause. We've done this before as a country, by the way. Wouldn't be the first time. That's why 1 in 7 drivers in the United States right now are uninsured. Most of those are illegals. How much do you think that adds to your insurance premiums? So it's not just housing, it's insurance, it's medical expenses, it's health insurance, it's property taxes. We have over 40 million people on food stamps, many of them illegal. Why are we paying for all this? All it's doing is increasing the cost of living for all of us, reducing the population, deporting the illegals, reducing legal immigration is the easiest, simplest, and best solution for our country and to bring back affordability, particularly in housing. In the meantime, if you want to learn how to navigate this future that seems to be increasingly uncertain, you want to reduce your market risk, obtain unlimited upside gains with no downside risk. You want your principal guaranteed. You want to make sure you have the best indexes available so you have the best upside potential. I have the performance reports for the 1, 5, 10 year and over 600 indexes. If you already have an index product, whether it be an annuity or life or whatever, and you want to compare and likely increase your returns by 2, 3, 4-fold even, contact me at yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show for more great information, and as long as it's on our money, in God we trust.
Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information.
Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.